December 19th, 2024. Silver prices in India are trading around 85,000 to 90,000 rupees per kilogram depending on the city. Nothing unusual yet, just another day in the precious metals market. But here's what most people watching silver don't understand. The metal isn't crashing on a single day, it's doing something far more interesting and far more revealing about what's coming in 2025. It's coiling, tightening, building pressure. And for anyone paying attention to patterns, December 2024 represents something critical. The setup phase before major price movements that could define the next 12 months. Let me show you what's actually happening with silver right now, why the volatility you're seeing isn't random, what December's price action tells us about supply and demand fundamentals, and why understanding this moment matters, whether you are watching markets or just trying to make sense of precious metals in an increasingly unstable financial system. Because what's happening to silver in December 2024 isn't about one day's price movement. It's about a structural shift that's been building for years and is now entering its acceleration phase. Before we talk about December 2024, you need to understand where silver was throughout the year, because the context matters. At the start of 2024, silver in India was trading around 70,000 to 75,000 rupees per kilogram. Nothing spectacular. The metal had been range-bound for months following weakness in late 2023. Then something changed. By May 2024, silver hit 93,500 rupees per kilogram. That's a 25% gain in 5 months. Prices spiked, demand increased. Industrial buyers started securing supply. Investment demand kicked in as inflation remained elevated despite central bank claims. But here's where it gets interesting. After hitting those highs, silver didn't crash immediately, it consolidated. Through June, July, and August, prices moved sideways between 85,000 and 92,000 rupees per kilogram. This wasn't weakness, this was accumulation. The pattern technical analysts call a bull flag. Prices rise sharply, then consolidate, then rise again. By October 2024, silver hit 96,000 rupees per kilogram in major cities. Another leg up. Another confirmation that something structural was changing in the market. And then came December. This is where people get confused. They see daily price movements, intraday volatility, and they think something dramatic is happening. A crash, a collapse, the end of the rally. But that's not what the data shows. Throughout December 2024, silver in India has been trading in a range. Some days up 1,000 rupees, some days down 900 rupees. This looks like chaos to casual observers. But to anyone who understands commodity markets, this is normal volatility for a metal that's moved 30% in a year. Here's what's actually happening. Silver's standard deviation, which measures price fluctuation risk, sits between 27 and 28. Gold's sits at 12. That means silver is inherently twice as volatile as gold. When you see silver move 1,000 rupees in a day, that's not a crash, that's Tuesday. The reason silver moves this way is structural. First, the market is smaller than gold. Less liquidity means larger price swings. A single large buyer or seller can move the market in ways that don't happen with gold. Second, silver serves dual purposes. It's both a precious metal and an industrial commodity. That creates conflicting demand signals. When industrial demand weakens, prices fall. When investment demand spikes, prices rise. These forces don't always move together. Third, silver is priced in US dollars globally. India imports virtually all its silver, so the rupee-dollar exchange rate directly impacts domestic prices. If the rupee weakens against the dollar, while international silver prices stay flat, Indian prices rise. If the rupee strengthens while international prices fall, Indian prices can drop sharply in rupee terms even if the dollar price barely moves. December 2024 has seen all three of these forces at work simultaneously. Let me break it down layer by layer. On December 18th, 2024, the US Federal Reserve held a policy meeting. Markets were expecting a rate cut, not just expecting. Pricing it in with 87% probability according to Bloomberg data. Rate cuts typically weaken the dollar. A weaker dollar makes commodities priced in dollars more expensive for holders of other currencies. This drives demand, but it also makes precious metals more attractive because lower rates mean lower opportunity cost for holding non-yielding assets. The expectation was clear. Rates cut, dollar weakens, silver rallies. Except the Fed did something unexpected. They cut rates, yes, but they signaled only 2 more cuts in 2025 instead of the 4 cuts markets had anticipated. This is called hawkish cutting. You ease policy but signal less future easing than expected. The result was immediate. The dollar strengthened, bond yields spiked. And silver, which had been trading near recent highs, pulled back. Not a crash, a reversion. The market had priced in more easing. When that easing didn't materialize, prices adjusted. In India, this played out as intraday volatility. Prices that were testing 90,000 rupees per kilogram fell back toward 85,000 in some cities. That's a 5,000 rupee swing. In percentage terms, about 5.5%. For silver, that's within normal volatility parameters. But here's what the media missed and what casual observers don't understand. This wasn't a structural breakdown. This was profit-taking after a strong run combined with a hawkish Fed surprise. The fundamentals driving silver higher didn't change. They're still intact. Let me show you what I mean. The industrial demand story is accelerating, not weakening. Over half of global silver consumption comes from industrial applications. Solar panels need silver paste for conductivity. Every panel requires about 20 grams. Global solar installations doubled in 2024. That's millions of additional ounces of silver consumed permanently. It doesn't get recycled. It's locked in panels for 25 to 30 years. Electric vehicles use 3 times more silver than combustion engine cars. Silver is in the batteries, the electronics, the charging systems. EV production is up 40% year over year globally. That's hundreds of millions of additional ounces of annual demand. 5G infrastructure requires silver components. Every tower, every antenna, every connection point. The build-out is accelerating across Asia, Africa, and Latin America. More demand? Medical devices, defense systems, electronics of every kind. Industrial silver consumption hit 680 million ounces in 2024, according to the Silver Institute. Projections for 2025 are 750 million ounces. That's 150 million ounces of increased consumption in just 2 years. And here's the problem. Supply isn't keeping pace. Global silver mine production in 2024 increased only 0.9% to about 820 million ounces. Most silver comes as a byproduct of copper, zinc, and lead mining. Miners don't dig for silver primarily. They dig for base metals and silver tags along. That means silver supply is constrained by base metal economics. If copper prices don't justify new mines, those mines don't get built. And the silver that would have come from them never gets produced. This creates a structural deficit, more silver consumed than mined. The gap filled by above-ground stockpiles that are being drained year after year. The Silver Institute estimates a deficit of over 200 million ounces annually for the past several years. That's 200 million ounces more consumed than produced every single year. Where does it come from? Existing inventories, government stockpiles, recycling. But these sources are finite. Eventually they run out. Investment demand adds another layer. In 2024, investment demand for silver exceeded 250 million ounces. People buying coins, bars, ETFs. Why? Because inflation remains elevated despite official claims. Central banks printed over $30 trillion since 2008. That money is still in the system. It doesn't disappear. It flows into assets. Gold is expensive. Over $4,200 per ounce as of December 2024. That's out of reach for many investors. Silver at $30 per ounce globally, about 85,000 to 90,000 rupees per kilogram in India, remains accessible. It's the working person's hedge against currency debasement, and currency debasement is accelerating. The US dollar has lost over 98% of its purchasing power since 1913. The rupee has lost similar amounts. Fiat currencies don't hold value long term. They can't. Governments always print more to cover deficits, fund wars, bail out banks. Silver, by contrast, has been money for 5,000 years. It can't be printed. It can't be created by central banks. There's a reason central banks globally are buying gold and silver reserves at the highest rates since the 1970s. They know what's coming. So here's the picture. Industrial demand rising, supply constrained, investment demand surging, and the metal is in a structural deficit. This doesn't resolve with one Fed meeting. This doesn't change because prices pulled back 5% in a week. This is the setup for a multi-year bull market in silver. December 2024's volatility isn't a breakdown, it's consolidation within a broader uptrend. Now, let me show you what happens next based on historical patterns. Silver doesn't move in straight lines, it never has. In 1979 to 1980, silver went from $6 to $50 in 18 months. But the path wasn't smooth. It spiked, pulled back, spiked again, pulled back again. Each pullback shook out weak hands. Each rally brought in new buyers. The pattern repeated until the final parabolic move. In 2010 to 2011, silver went from $80 to $50 in 12 months. Same pattern. Spike, pullback, consolidation, spike higher. The volatility was extreme. 10% moves in a week were common, but the trend was clear. Higher highs, higher lows, structural uptrend. We're seeing the same pattern now. Silver bottomed around 70,000 rupees per kilogram in India in early 2024. It spiked to 96,000 by October. That's 37% in 10 months. Then it pulled back to 85,000 in December. That's an 11% correction. In a bull market, 10 to 15% pullbacks are normal. They're healthy. They reset sentiment, clear out leverage, and set up the next leg higher. What matters is the trend, and the trend remains intact. Silver is making higher lows. Each pullback finds support at a higher level than the previous one. This is textbook bull market structure. So where does it go from here? Based on supply-demand fundamentals, analyst projections, and historical patterns, here's what the data suggests. Short-term December 2024 into January 2025, expect continued volatility. Range-bound trading between 82,000 and 95,000 rupees per kilogram. The Fed's hawkish stance will keep the dollar strong near term. That caps silver's upside temporarily. But underneath, the structural drivers remain. Industrial demand doesn't stop for holidays. Solar panel production doesn't pause. EV manufacturing doesn't take breaks. The consumption continues regardless of short-term price action. Midterm, first half of 2025, if the Fed cuts rates as projected in March and June, the dollar weakens. Commodity prices rise, silver breaks above 95,000 and tests 110,000 to 120,000 rupees per kilogram. That's a 30 to 40% gain from current levels. Not guaranteed, but probable based on how silver responds to monetary easing. Long-term 2025 into 2026, if the structural deficit continues, which all projections indicate it will, silver could test 150,000 to 200,000 rupees per kilogram. That sounds aggressive, but remember, silver in US dollars is currently around $30 per ounce. The inflation-adjusted high from 1980 is $170 per ounce. If silver just reverts to its historical high in real terms, we're talking about a 5x move from here. In rupee terms, that translates to much higher levels because the rupee continues weakening against the dollar. Currency debasement amplifies precious metal gains in local currency terms. Some analysts, including those at Choice India, project silver could reach 200,000 rupees per kilogram by 2026 to 2027. Pocketful's analysis suggests 245,000 by 2027 if global prices hit 75 to 70 cents per ounce and the rupee weakens further. Are these numbers certain? No, markets don't move in straight lines, but the fundamentals support these projections. Supply deficit, demand growth, currency debasement, historical precedent, all point in the same direction, higher. Now, here's what this means for people watching silver. If you're observing precious metals as an economic indicator, silver's behavior tells you something critical. The market is pricing in long-term currency instability. When industrial and investment demand both surge simultaneously, when central banks buy record amounts of gold, when silver consolidates after major moves instead of collapsing, these are signals that smart money sees something coming. Not next week, not next month, but over the next few years, a repricing of hard assets relative to fiat currencies. If you're considering silver as part of a broader observation of economic trends, the December 2024 volatility is noise. What matters is the bigger picture, the structural deficit, the demand growth, the supply constraints. These don't resolve quickly. They take years to play out. And during those years, silver will be volatile. It will have 5%, 10%, even 20% pullbacks. But if history is any guide, the trend will be higher, not because of speculation, because of mathematics. You cannot consume more of something than you produce indefinitely without prices rising. Here's the pattern people miss. Every major silver bull market has had multiple corrections that looked like tops. In 1979, silver pulled back 25% in a month before making the final run to $50. In 2010, silver dropped 15% in 2 weeks before rallying to $50 again. Each time, casual observers called it the end. Each time, it was just a pause. December 2024 looks like another pause, not the end. The beginning of consolidation before the next leg. The fundamentals are too strong, the deficit too large, the demand too persistent. Let me show you one more piece of evidence that this isn't a crash scenario. The gold-silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, it averages around 60.1, sometimes as low as 15.01 in times of silver strength, sometimes as high as 100.1 in times of silver weakness. As of December 2024, the ratio sits around 85.1 to 90.1. That means silver is historically cheap relative to gold. Not expensive, cheap. When this ratio is high, it signals silver is undervalued. When it reverts to the mean, silver outperforms gold dramatically. A move from 90.1 to 60.1 would mean silver gains 50% even if gold stays flat, and gold isn't staying flat. Gold is at all-time highs above $4,200 per ounce. When gold leads, silver follows with more volatility, the ratio will compress, silver will catch up. That's how this relationship works across cycles. This is the bigger picture. Silver is not crashing in December 2024. It is consolidating within a structural bull market driven by fundamentals that will take years to resolve. The volatility you're seeing is normal for this metal. The 5% to 10% swings are par for the course. And the setup for 2025 remains bullish based on supply-demand imbalances that aren't being solved. So when you hear about silver crashes or panic buying opportunities, remember this. Markets don't move on single days. They move on structural trends that play out over months and years. December 2024 is one data point in a much larger pattern. And that pattern, based on everything the data shows, points higher. Not in a straight line, not without volatility, but higher nonetheless. The question isn't whether silver moves up from here. The question is whether you understand the pattern well enough to not get shaken out by normal volatility, because that's how bull markets work. They climb a wall of worry. They shake out weak hands, they make you doubt. And then they reward those who understood the fundamentals all along. Silver in December 2024 is exactly where it should be. Volatile, consolidating, and building energy for the next move. The fundamentals haven't changed. The deficit persists. The demand grows. The supply remains constrained. This isn't the end. It's the middle innings. And if history repeats, which it tends to do in commodities, the most explosive moves are still ahead. Not financial advice, just pattern recognition based on data that's been consistent for decades. Silver is doing what silver does, moving volatility, building pressure, preparing for the next leg of a structural bull market that most people won't recognize until it's already happened.